Hello, everybody, and welcome to Weekly News Live. Me and Nico are coming at you today. Unfortunately, not from a very glamorous, soundproofed podcast studio like last week's episode. We're back to normal, Nico. I'm afraid in our virtual environments. How are you today?
I'm awesome. I'm awesome. And once again, and that's a funny story because I was approached by some of our fans. And shout out once again for the lovely people, actually, during Sigma, just stepping towards me and congratulating the both of us. Indeed, the four of us, including Pierre and Connor as well, to this awesome podcast we're doing and the live stream. So once again, shout out to each and everybody stepping up. Because usually, if you don't participate within the podcast during or live stream within the chat, we don't know and we're not aware that you're actually listening. So always feel free to approach us and get in touch with us. We are live and vivid and likable persons.
Exactly. I could not approach you if I saw you at a show, Nico. It'd be like seeing a famous person out in the wild. Um, but yeah, it was great to be in our podcast studio in our Malta office last week. Has all the mods and cons. If you did miss that episode, you can go to Next.io's YouTube channel, and the video will be available there under the live tab, where me, Nico, and Pierre joined us, and we talked about DraftKings becoming a new market leader in the US. And also the launch of ESPN Bet. So yeah, feel free to go and seek that out if that interests you. Nico, you said thank you to our viewers, and I'd like to echo that. I'll also say a big thank you today to our sponsors, Playson and Bombay Group, and to everybody kind enough to watch along and comment in the chat. Please send your comments in, and we'll do our best to read them out during the broadcast today. Big hello to Nico, Rory, and Elizabeth, who have already said hello. Thanks for joining us, guys. And I think we can crack on with 10 and 5 now, Nico.
Yeah, sure. So, starting with a 10 and 5, it's once again a little bit of Germany, as there's a study about the new gambling treaty, which calls on GGL, the German regulatory, to tackle black market fallout. So, the University of Leipzig study used data from Nielsen Media Germany's online meter panel, recording online activities of approximately 25,000 consumers in Germany, recording visits and engagements with over 700 gambling domains. Please be aware, in Germany, they had been giving out roughly 35, 38 licenses. So it's quite interesting that we're speaking about 700 gambling domains. Monitoring developments as of March 2023, only about half, 50.7% of German gamblers engaged with licensed providers. The report detailed a significant shift towards unlicensed EU, it's 29%, and offshore, 20% operators observed since January 2019. This, of course, caused an action by the regulator themselves, the GGL, as they reject criticism of data collection on black market exposure. Who would have thought? So, the identified illegal websites are estimated to represent a market volume ranging from 300 million to 500 million, accounting for approximately 2 to 4% of the regulated market. And the GGL stressed that its findings are based on diverse methodologies, including the analysis of unregulated platforms and their visitor activities, as well as on evaluation of affiliate marketing networks. Furthermore, the GGL emphasized that its surveys are regularly adjusted and further developed. So quite interesting, and we will get to this a little bit more in detail during our talk. Heading over to the US, as US commercial gaming revenue hits a record of 16.17 billion in Q3. Q3 2023 was the US commercial gaming industry's best third quarter on record, generating the already mentioned 16.17 billion US dollars, according to the American Gaming Association, short AGA, commercial revenue tracker. So the revenue was up 6.1% year over year, and it was the 11th consecutive quarter of annual revenue growth, on the second highest grossing quarter yet, behind the Q1 2023. So there's only one way up in the US, and it's skyrocketing into the sky. So touching down on the conversation we had last weekend as well with the awesome and beautiful looking Pierre Lind himself, FanDuel makes 70% of all New Jersey sportsbook revenue during October. The national debate about the top player in the sports betting market may have caused a debate in the last few weeks. But in New Jersey, there's no debate at all, as data shows that FanDuel made of the entire state's revenue last month. So the new New Jersey Division of Gaming Enforcement data displayed that FanDuel made $64.1 million in revenue from the Garden State last month, and the entirely market was $92.3 million. As numbers don't lie, shout out to FanDuel once again. Staying in the US, as the Florida Supreme Court denies requests to take Hard Rock Bet offline. Roughly 2 weeks ago, West Flagler and Associates petitioned the court to shut down the recently relaunched Hard Rock Bet until the case could be settled by the state's highest court. The court apparently did not agree with West Flagler's concerns and denied the request last Friday. The Seminole Tribe of Florida is pleased with this anonymous decision by the justices of the Florida Supreme Court, which has been stated by the Seminole Tribe of Florida. The EGBA welcomes Aircash as first associate member. So the headquartered in Croatia, Aircash is a player in the digital payment platform, running their own e-wallet and cash to e-wallet as well, with more than 10,000 point of sales. Finally, delivering compliant financial services across Central and Eastern Europe, are now member of the EGBA. Shout out to them. So, an update from Brazil, as the sports betting tax and iGaming tax rate is set at 12%. So, a reduced 12% tax rate for Brazil sports betting was confirmed after the country's Economic Affairs Commission approved Bill 3626/23 on 22nd of November, which was yesterday. And while an attempt to remove iGaming from the legislation also failed during yesterday's session, after online casino was unexpectedly added to the sports betting bill in September. Once again, shout out to the Gauselmann Group, as they win the tender for casino concessions in the German state of Lower Saxony. So the Gauselmann Group announced Tuesday that it has won the tender for the casino concession of the German state of Lower Saxony, resulting in the group having the opportunity to operate up to 10 casino locations, retail casinos. So the concession allows for the state licensed location to be operated under the umbrella of the Merkur brand from 1st September 2024, initially for a period of 15 years. And just to put this a little bit into perspective, with this retail license for Lower Saxony, they are also able to apply for the iGaming offerings of these blackjacks, roulette, etc., for the state of Lower Saxony as well. Then Belgium's attorney generals provide guidelines for prosecution of gambling breaches. So the Board of Attorney Generals has drawn up guidelines intended to clarify norms for the prosecution of infringements of gambling regulations. And last but not least, the Swedish Spelinspektionen gains approval to increase Swedish gambling fines, as from 2024 the inspectorate will be able to impose the same penalty fees for AML infringements as those under the Gambling Act of 2018, with the specific maximum amount for the individual violations as well. So this has been the 10 and 5.
Thank you very much, Nico. That was a great little roundup there. Just want to say a quick hello to Bogdan and to Jadip and to Katie, who have joined us since you started. Hi, guys. Thanks for joining us today. Nico, obviously there was a lot of German headlines in that 10 and 5. And there's been a bit of another sort of ding dong between the regulator and the trade bodies over in Germany. I'm just wondering if you could kind of give us the latest on the channelization row that seems to be developing over there.
Yeah. So first of all, I would just do pretty much a wrap up of the panel we had roughly 4 weeks ago, 3 to 4 weeks ago, where we had the panelists and leading trade union representatives of Matthias Dahms, Dirk Quermann, and Jörg Hoffmann as well. And this all comes up to literally one fact. While the operators see a significant amount of players actually resigning and, not depositing money on the licensed entities, we also see a decline in the tax revenue. So as soon as it comes to tax revenues, it's a pretty much reliable number, as this is published on a monthly basis. And as said, if you want to dive deeper into this topic, feel free to re-listen to the episode we had 4 weeks ago. But just to sum up things a little bit, so especially for casino games, virtual slots, if you're interested in playing blackjack or roulette, which prior regulations, this made 50% of the overall iGaming revenue, you actually can't use these kind of games in regulated markets. Guess what? So if you still want to play these games, of course you need to sign up at non-licensed and so-called black market operations, while the operators see at least these 50% being gone. The GGL still states, and these numbers are actually decreasing in a negative way, while the channelization rate during the Gaming in Germany conference was stated and labeled with 5%. The latest numbers is, channelization rate, or the black market operations represent 2 to 4%, which implies a channelization rate for 96 up to 98%. And as already stated so often, you can actually just solve a problem as soon as you realize there is a problem. And as stated, declining tax numbers, facts of underlying studies, and analyzing 25,000 players is a significant amount and a reliable empirical study as well. While GGL still states like, okay, we have our own methodology and it works. Unfortunately, they don't actually specify whatever methodology they are using. So fingers crossed, at some point, people at GGL will wake up and face reality. And as soon as this might start, we will actually, and hopefully fingers crossed, see a turning ship like we've seen in Denmark as well and already. And as said, fingers crossed that GGL will finally acknowledge that things aren't going in the right direction.
Yeah, fingers crossed. You might be waiting a little while though, Nico. We'll have to wait and see. But looking away from Germany now and moving on to kind of our first main topic of the show, and a whirlwind few days for Catena Media. So Catena basically finished its strategic review with the sale of its Italian affiliate assets for 19.8 million euros this week. These assets, one of which we now know was bought by Oddschecker, they generated revenue of 7.8 million euros and EBITDA of 3.4 million euros in the 12 months to September 2023. And basically, this sale kind of triggered Catena's exit from the Italian market, and the money that they made from the sale is going to be used to repay debt. This is what the CEO Michael Daly had to say on the matter. He said, "The sales further sharpen our strategic focus and strengthen our financial position, allowing us to streamline operations further and redeploy capital into our core areas as we double down on capturing expanding opportunities in regulated markets in the Americas." So, reading between the lines, Nico, that sounds to be like a kind of sole focus on the US now, after selling, pretty much everything else that they owned over the last 18 months. We know that they sold their flagship brand, Ask Gamblers, to GIG recently, and we'll sort of dive into that in a bit more detail later. But it also sold its UK and Australian sports betting brands for €6 million earlier this year. And just as that review's come to an end now, they said basically all of the sales agreed on as part of the review raised a total of €76 million. And the review will result in annualized cost savings of between 3.8 million and 4.2 million euros going forwards. So, Nico, yeah, I guess the big question here is was it worth it for Catena?
So, in the end, you never know if it's worth it. But I'm pretty sure they have been, or they are well aware of their investments in the US, and it just seems like, okay, they are putting all their eggs into this one basket, which means, okay, all in on the US side. And as already stated within the numbers we are seeing on the US side with the AGA, 16.17 billion just within one quarter. As of now, it seems like the big sharks in the US are just positioning themselves also with Better Collective. 2 weeks ago, they paid 1 or 2 weeks ago, they roughly paid 161 million Canadian dollars, if I'm not mistaken, for an entity in Canada. So this is for sure a deep pocket and a big guy's game all over in the US. I don't know if this will play out, but usually, and this is not an investment advice, but if you are have some background within investment, you should always diversify your portfolio, because if plan A doesn't work out, usually your plan B comes into place. And if the strategy of your plan B is labeled as hopefully plan A works, it ain't good at all.
Yeah, I think there was a degree of kind of mixed messages from Catena on this issue as well, because one of the quotes in the press release said that the review kind of reflected, Catena Media's belief that stable, regulated markets offer the best framework for long-term engagement and sustainable growth over time. But they've just sold their UK assets, Australian assets, and their Italian assets, which all fit that definition of kind of, long-term and sustainable markets, regulated markets. So, yeah, I'm not sure the investors are kind of behind this story, if you like, and they were pretty impressed, and they dumped stock in Catena as well on Q3 results day, and the share price actually went down by about 22%, I think, at one point. If we have a closer look at those Q3 results, revenue dropped 28% year on year to 15.9 million. And US revenue, Nico, where as you just said, they're kind of putting all of their eggs in that basket. US revenue fell by 29% to 13.3 million, and new depositing customers also fell by 34% year on year. So a pretty bleak quarter. And I think hopefully our producer Lorena's got a graph on that. There we go, beautiful, on that financial performance now, which doesn't make particularly pretty reading. But yeah, Catena said that those decreases were because it was mostly because it was transitioning away from a kind of CPA, cost per acquisition model in the US, and towards a rev share model instead. And Nico, I was hoping you could kind of explain for our viewers that might not be aware kind of what that means for affiliates.
Could you just repeat the question once again? I was just looking up something.
Yeah, they're basically they said the reason for these declines was because they're moving away from a cost per acquisition CPA model and into a kind of rev share model instead. So I was hoping you'd be able to sort of explain the difference between those models for our viewers.
So if you just literally take a look at these models, I'm not. So first of all, you have a regular CPA, which is the cost per acquisition model, and cost per acquisition only, which is like as soon as a customer, first of all, a customer has been transferred to your operations by an affiliate. Usually, these customer come with a tracking ID, so you could, as an operator, literally see, okay, customer XYZ was handed over by affiliate ABC. So a CPA means, and this is usually written within the contract, as soon as a transferred customer deposits, which is called the FTDs, first time depositors, a certain amount of money, 25, 50 USDs, this will initiate a payment towards the affiliate. Usually, a CPA, as an example, in the Dutch market, the Netherlands, is around 300 euros. So you will get a benefit of 300 euros, but that's it. Within the rev share, usually you don't get a CPA, but whenever the overall customers are on a losing basis, so you have a positive revenue of these customers, then the affiliate get a percentage of this revenue, which means they don't get the initial CPA, but they get a rev share of 35, 45%. It just depends on the quality of the affiliate you shifted over. But then you're getting constant revenues, which is way more attractive. And the overall and most liked model is the so-called hybrid model, which combines the CPA and the rev share, which is then resulting in a less CPA. Example giving probably in the Netherlands of around 100, 120 euros per FTD, combined with a rev share of 30%. And then you actually gain both of the benefits of both of these worlds with the CPA and the rev share usually on a lifetime basis.
Yeah, great stuff, Nico. Thank you very much for that. And I think rev share is kind of going to be more sustainable for these affiliates in the long run, but it looks like it's going to result in some short term headwinds. I think Better Collective were guiding to that as well, and as part of their Q3 results. But to kind of rub salt in the wounds for Catena Media, Ask Gamblers, which was the brand that they sold to GIG, appears to have kind of really gone from strength to strength under new ownership. And analysts on the earnings call were keen to know kind of why Catena hadn't been able to unlock that potential in the brand, which is now thriving according to GIG. And if we compare Q3 2023 to the run rate in February 2023, GIG said that both player intake and revenues were up by around 45% on Ask Gamblers. So basically the CEO, Michael Daly of Catena, was asked, why is this by analysts on the call? And he kind of hinted that that Catena would have been able to boost Ask Gamblers' revenue by targeting kind of untapped markets, but he said he didn't really want to deal with the regulatory hurdles. He said that Catena had kind of received letters from authorities in unregulated markets, and that the company had taken the decision to stop targeting those markets. So he's kind of suggesting there, that GIG has a bit of a stronger appetite for regulatory risk in perhaps kind of grayer markets for that brand, which I think the investors probably took at face value. But then what was particularly interesting is a GIG executive went to LinkedIn. He went into LinkedIn this week, and I hope we've got a little graphic here for you. But he basically appears to have suggested that the bulk of growth at Ask Gamblers has so far come from regulated markets, such as the UK. I don't know if we're able to get that status on stream. But yeah, he basically said, we've seen growth globally, but most significantly, it's been in regulated markets such as the UK. We have barely started to scratch the surface of unleashing the potential of Ask Gamblers. So, yeah, sorry, that's not the graphic. So don't worry about that for now. There we go. There it is. So yeah, you can have a quick read of that for yourselves. But yeah, Nico, what do you kind of make of that? Obviously, we're never going to, have the inner kind of insight to see what GIG is doing differently under the hood, but it doesn't reflect particularly well on Catena that there's been this kind of immediate turnaround in the brand and its fortunes.
Especially if you just take into account the time span, right? We are speaking about a time span of roughly 6 months, 6 to 8 months, if I'm not mistaken, or 9 months, right? And if we just take a look at the overall metrics, right, we just see, okay, it's already gone, that they significantly increased the player value, and you already gave the numbers as well, with a rev share which is now roughly or it's an increase, what did you state, like 45%, if I'm not mistaken?
Yeah,
and this is first of all, and never forget, we are talking about an already saturated market. So it's not like as gamblers as of now are now working in a market which has not yet been open, and all of a sudden they are providing traffic, what you can see in the US. So it's quite interesting that they obviously had been able to use literally the same approach and increase the numbers significantly. And this for sure just amplifies and highlights that the decision of buying as gamblers has been a well thought through acquisition. And I'm pretty sure that Marcel and Andrew, two of the leading C-levels at GIG, will have a lot of fun just dealing with these numbers as well.
Yeah, fair enough. Although I think they're on the sports side, but yeah, right, you are. Marcel, especially as he's looking at additional acquisitions, I think, in his new role. So yeah, Nico, let's go from one kind of faltering gambling company to another, and this is the news that Entain is this week dealing with a further shareholder revolt. Some big kind of US hedge funds have waded in to express their discontent at kind of the company's performance over the last few years. Do you want to take us through this story briefly?
I did not read the overall story through, but if I'm not mistaken, just let me look this up. If you want to start us up,
Yeah,
feel
sure,
free to do so.
I can do it. That's fine. So yeah, this is basically the news that New York-based hedge funds Dender Capital and Sachem Head Capital Management have joined Eminence Capital in going public with their doubts basically over Entain, its performance and its leaderships. They've kind of built up their stakes in Entain so that they can gain a bit more influence. And basically, if you look at the share price performance of Entain, I think we've got a graphic that we should be able to show you now. You can kind of see, where this discontent is coming from, because this is a 2-year graph that displays Entain's stock performance. And as we can see there in November, so this month, it reached a historic low, which doesn't reflect. There's obviously a lot of moving factors in that regard, both macro and micro. But if you're one of the main hedge fund shareholders in Entain, you're going to be pretty disappointed with that performance, I would imagine, and they're kind of going public with those thoughts now. What's really interesting, Nico, thanks for that, Lorena, is that what they want to do is basically build up a position on the board now, so they've got even more structural influence at the company, because Entain recently had an investor day, and it said it was going to create a new executive committee, so it has better oversight of these kind of issues. And there's going to be 4 people recruited to that board. But basically, a gentleman called Ricky Sandler, who is the CEO of Eminence Capital, he now wants a position on that board by the sound of it, or he at least wants a position in the company so that he can help appoint people to that board. And that will mean that they get a lot more of a kind of significant steer over the future strategy of the business as they try to reverse those fortunes. But a bit of background on Ricky Sandler, because this is when this was in June this year, and Eminence Capital was kind of the first big shareholder to go public in its criticism of Entain. And this was focused on the acquisition of STS in Poland. And they really weren't happy with kind of how that deal was financed. And the quotes from Ricky at the time were very critical indeed. He said, while calling this deal accretive on an earnings per share basis may be technically correct, it demonstrates that management either doesn't understand finance, or worse, that they believe the company's shareholders are naive. So that seemed to be sort of the final straw for Ricky and Eminence Capital, and they've obviously got some more influential investors to back them up and push for change at the top of Entain, with the leadership of Jette Nygaard-Andersen now being kind of called into question. So a really difficult period for Entain. I'm sure you'll agree, Nico.
Yeah. So and just remember that, like, also 2 or 3 weeks ago, 2 of the C levels just invested heavily into Entain as well. So they obviously have good faith in what they're doing. And usually, and just based on another article, statements of investors usually are based on, a certain peer group, and Flutter is the peer group of Entain, while the share price of Entain significantly went down. The share price of rival Flutter has climbed 11% this year. So you can actually see, okay, it's pretty much the same big ship, Flutter and Entain. While we are going down, they are going up. And then you literally don't have a lot of arguments which manifest your own position. And I'm not taking DraftKings into account as well, who also had a significantly increase in their share price as well. If you would compare the pretty much share price mid 2021 with an actual share price, there would be literally no gaming company seeing any kind of increase, as they all decreased from mid of 2021. But as stated, if you just take the year 2023 into account and just compare within your peer group, arguments don't come easy.
Yeah, exactly. And you're right to point out that year-to-date difference between Entain and Flutter, which, as you rightly said, is up 11%. It's not like you can say, oh, well, this is happening to everybody, so, what are we meant to do about it? Because clearly it isn't. And I think the reason behind that kind of difference in share price performance seems to be that Flutter was much quicker to roll out kind of safer gambling tools in the UK. And it's already soaked up that those declines, whereas Entain and 888 were probably slower to do that, and are now feeling the effects of it much stronger at a bad time, really, in general. So yeah, like you say, the executives have put their money where their mouth is, and they've bought a bunch of stock. I think Jette doubled her own shareholding. The chairman, Barry Gibson, quadrupled his. So that, yeah, they obviously have faith. They think they're doing the right thing. But it's fair to say people disagree with them, including 2 London-based hedge funds in Purback Capital Partners and Ilex Capital Partners, who aren't shareholders in Entain, but they've actually taken short positions against the company. So they're sort of, they're predicting it's going to be a bumpy ride ahead for Entain, I'm afraid. But time will tell, and I'm sure we'll cover those developments on weekly news as and when the time is right. But I think that probably brings us to the end of this week's weekly news. We've covered a lot of bases there, Nico. Thank you so much for your contribution and an excellent 10 in 5 this week. A big thank you, obviously, as well to everybody who's commented. It's great to see a busy comment section on the stream. So thank you so much for your support. And also a big thank you to Playson and to Bombay Group for supporting us with their sponsorship. So yeah, we'll be back again next week. Thank you very much and goodbye.
They ain't coming close to me. Flow is on atomic, I'm starting fires through poetry. The heart's out, staying loyal, no falling out. And if you step into the court, be ready, we ballin' out, yeah.